A lot of people believe that the only way to make money in the stock market is to buy low and sell high. And to a certain extent, that is true. But some traders follow the ideology of buying high and selling higher. These people are known as momentum traders. And their trading methodology is known as momentum trading. The basic definition of momentum is the rate of change of a moving object. In other words, it refers to the speed at which something moves. If we think in terms of a train, whenever a train starts from a station, it first accelerates. Then, once we reach a preferred speed, the driver stops the acceleration and maintains the speed of the train until we reach the next station. Once we reach near the next station, the driver decelerates the train by applying the brakes. When the train is accelerating, we call that as an increase in momentum, and when the train decelerates, it's called as reduction in momentum. As a momentum trader, we want to participate during the acceleration phase of a stock. There are two advantages of trading momentum. Number 1. In a momentum-based trading strategy, if we get our entry wrong, most of the times that will not harm us. Because the momentum is in our favor. The market will have to move against the momentum to trigger our stop loss. Momentum is like the flow of a river. It does not matter how you enter the river. You will most likely flow with the river. So from a technical analysis standpoint, we can mistime our entry and still get away with it. The second advantage is that we are looking to enter and exit the trade in a relatively short amount of time. The difference between swing trading and momentum trading is that in swing trading, we buy a certain stock and wait for it to reach our target. If the stock is strong, it may reach our targets within 3 to 5 days. But if the stock is weak, it may take weeks or months to reach our targets. In momentum trading, our approach will be a little bit different. As a momentum trader, we buy on opportunities in short-term uptrends, and we exit when the momentum starts to decrease. Most of the time, our trades will not last for more than 7 days. This is because most of the momentum stocks follow the same pattern. They make a good 15 to 20% move within a couple days, and then they consolidate for a few weeks before making another up move. In fact, if we enter a particular trade, and the stock does not move for 2 days, most of the time we will exit. So there is no time wasted in momentum trading. We are in and out of the stock within a couple of days. If you do your research, you will find out that a lot of successful traders use momentum trading to generate their returns. For instance, Mark Minervini, Oliver Kell, and David Ryan used the momentum trading approach to win the U.S. investing championship over several years. So in this video, I will be sharing my own momentum trading strategy along with exact entry and exit rules. But before we start, be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. First, we need to understand our stock selection criteria. In this strategy, we are only interested in those stocks that are market leaders. Market leaders are basically those stocks that are performing relatively better than the broader indexes over a 3-month and 1-year period. In other words, we want to trade only on those stocks that are outperforming the general markets. To find such stocks, we first need to find out the performance of the broader index. The broader index will be different from country to country. For instance, in the US, the index is S&P 500. Similarly, in India, the index is Nifty 50. So if we are trading in the US stock markets, we will first identify the 3-month performance of the S&P 500. If the S&P 500 has made 17% in the last 3 months, we will scan for stocks that have gained more than 17% in the past 3 months. So this is one way of stock screening. Another way of doing it is by simply looking for stocks that have made more than 20% move in the last 3 months. This will pretty much give you a list of stocks that are market leaders. A small adjustment to make here is that we want to look for stocks that are small and mid-cap. Based on the country you trade, look for the thresholds for small and mid-cap stocks, and only trade in them. The reason I avoid large cap stocks is because it takes a lot of money for a large cap stock to move 15 to 20%. And you will rarely find these parabolic moves on large caps. So the best trade plan is to avoid large cap stocks. Once we have created the list of market leading stocks, we will add them to our watch list. At this point, you might have 500 to 700 stocks on your watch list. But don't worry, we will not trade all of them. We will add more rules to reduce the stock list to potentially 30 to 40 names. For that, we need to move on to our charts and analyze each of them. Once we have moved to our charts, the first thing to do here is to switch to the daily timeframe. For this strategy, we will only use the daily timeframe. Now, moving on, let's look at the indicators that we will use for our analysis. First of all, we will use the relative strength indicator. Just go over the Indicators tab and search for relative strength. But note that we are not talking about the Relative Strength Index or the RSI indicator. We want to plot the relative strength. You can use any of these top 4 indicators as they do the same job. I personally use the indicator created by a guy named Modulus. But in the end, all of these do the same job. Once you plot the indicator, you will need to modify the settings in order to use it. So go into the settings of the indicator and change the period to 260. This is simply because in a calendar year, we have approximately 260 trading days. Then we will change the comparative symbol to the major market index that is present in your country. For instance, in the US, we will set this to SPX, which is a ticker code for S&P 500. Once we apply these changes, we will have successfully plotted the relative strength on the stock. So how do we interpret this indicator? If the current relative strength value is below the zero line, then we can say that the stock is currently underperforming the broader markets. And if the current relative strength is above the zero line, then we can say that the stock is outperforming the broader markets. A point to note here is that we don't want to trade in the stocks that are narrowly outperforming the index. We want to trade those stocks that are strongly outperforming the broader markets. So on the relative strength, we want at least the rating of 0.3. That is our lower limit. We will not trade in any stock which has a relative strength rating less than 0.3. Now, let's plot another relative strength indicator, but this time, we will keep the period 65. This is because we want to look at the relative strength of over the past 3 months. In a 3-month period, we have approximately 65 trading days. So we will change the period to 65. Now, we want to only look at those stocks that are above 0.3 on both the relative strength indicators. These stocks will be stocks that are outperforming the index on a yearly and 3-month basis. The third and last indicator that we will use is a 21-period exponential moving average. The 21 EMA will help us in identifying the trend of the market. Though, through our screeners, we will already be looking at stocks in an uptrend, but the moving average will confirm the uptrend. So, we want to look for stocks where the price has constantly stayed above the 21 EMA, and the EMA is sloped upwards. Such stocks will be the strongest. To summarize, we want the stocks to be showing relative strength above 0.3 on both 3-month and 1-year basis. Then we want the price to stay above the 21 EMA, and we want the EMA to be sloped upwards. Once all of these conditions are met, we will keep these stocks in our watch list and delete the rest. At this point, your list might consist of only 30 to 40 names. These 40 names are the strongest stocks among the markets. Now, we cannot simply buy all of them at once. We need to look for specific entry points to pinpoint our entry. You can use a lot of popular entry techniques to enter on such stocks. For the purpose of this video, I will be sharing 2 entry triggers that I have found extremely useful in my experience. The first one is a simple pullback to the 21-period EMA. The reason we use the 21-period moving average is simply because there are approximately 21 trading days in a month. Therefore, the 21 EMA gives us the average price of the stock over the last 1 month. Also, 21 is a Fibonacci number as well. Therefore, the 21 EMA will provide a strong support to the price in a strong uptrend. We will not simply buy at the 21 EMA, but when the price reaches near the 21 EMA, we will look for candlestick confirmations to enter the markets. This is a very simple approach, but the fact that we are buying the best stocks simply gives us the edge in our strategy. Let's look at some examples to understand our trades. So on this chart we have the US stock Peabody Energy that goes by the ticker symbol BTU. I want you to focus on this area of the chart. At this point, we can clearly see that the price was in an uptrend. The price was trading above the 21 EMA, and the EMA was sloped upwards. The 3-month RS line was at 0.68, and the 1-year RS line was at 2.61. This clearly states that the stock was outperforming the general index by a strong distance. Then we saw these 3 consecutive red candles that lead to a short-term pullback to the 21 EMA. On the 21 EMA we see that the price makes this small doji candle. The doji candle is a strong signal that the buyers and sellers are struggling for power. It also indicates that the sellers that sold on this down move might be exhausted, and the buyers might take control of the markets again. Therefore, it is a clear candlestick pattern that has appeared right at the 21 EMA. So we will buy on this candle. For stop loss, I like to keep a standard 8% stop loss with this strategy. For targets, we expect a 15 to 20% up move. But it's not always the case. Sometimes the price might just go sideways. So we will need to keep a track of the price action after our buy trade as well. If the price stays around our entry for the next 3 days, then probably the trade will fail. So we need to exit our position. Anyways, if the trade does go in our favor, we will look to book half our position at 8%. And we can trail the remaining half to 16%. On this trade, the stock made a 23% move within just 4 days. Here is another example. On this chart, we can see that the price was in an uptrend as it was trading above the 21 EMA, and the EMA was sloped upwards. Then, we see that the price makes this pullback with small red candles. When the price reaches the 21 EMA, it creates this strong hammer candle with a huge downside rejection. This clearly shows that a lot of buyers entered this stock on this day. So this is a bullish candlestick pattern that has occurred right at the 21 EMA. So we can buy at the close of this candle. We can keep our stop loss at the standard 8% from our entry price. And we can exit half our position at 8%. We can exit the other half at 16%. The price actually shot up by a little over 30% on this trade. So this was one way of entering a momentum stock. Another way of doing this is by trading the breakout of a base. A common characteristic among these momentum stocks is that they often create a sideways range after making new highs. The most important thing to note here is that the consolidation will almost always occur after a strong move up. The main reason for the congestion is profit taking. When the price made this strong up move, the people who bought here will be sitting in a huge profit. So, they might start booking their profits and looking to buy other stocks. Therefore, their sell orders create this sideways zone. For their sell orders, there are equal buyers that prevent the stock from going lower. This creates this base formation. Then, when the final seller sells his shares, there is no seller present above the price. In other words, the amount of buyers is so high that they overcome the sellers. When the price finally breaks above the base, the price will often shoot up with a lot of momentum. We will be looking to enter on these breakouts. Let's look at a trade example to understand this well. Look at this chart. On this chart we see that the price made a huge up move before forming this tight base. The base was created right around the highs. We can also see that the price was in an uptrend as it stayed above the 21 EMA, and the EMA was sloped upwards. We can also see that the RS rating for 3 months was around 0.8, and the RS rating for 1 year was above 0.5. So this was an exceptionally good stock that was creating a base right around the highs. We see small candles throughout the base, and we witnessed rejections on the upside and downsides. Then during this 4 to 5 days the price action dried up and created a strong consolidation just prior to the breakout. On this candle, the price finally broke above the base, and we enter at the close of this candle. We keep our stop loss at 8% below our entry. And we will target 8 and 16% move. Here is another example. On this stock, we see that the price made a 57% up move prior to making this consolidation. Then we see that the stock consolidated for over a month. There are small candles throughout the month as the price goes sideways. On this candle, the price finally broke above the consolidation with this strong green candle. We will enter a long position on the close of this candle. We will keep our stop loss at 8%, and we will target 8 and 16% respectively. And as you can see, the price achieved our targets on this trade. So these were 2 entry triggers that I have been using that can really help you in achieving market-beating returns. If you want to learn more about this strategy, then I have 2 books that I would recommend to you. Number 1 is How to Make Money in Stocks by Williams O'Neill. This book will help you understand how to identify momentum stocks based on technical and fundamental parameters. The other book is Think and Trade Like a Champion by Mark Minervini. This book will help you understand the nitty-gritty of momentum trading. This book also covers risk management extensively. So these 2 books will help you understand this strategy even better. Other than that, I suggest you to keep a journal and record each of your trades on that book. Your journal book is something that will help you the most in your trading journey. So, that brings us to the end of this video. If you liked this video, then be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. See you soon.